When it comes to investing, many people are faced with a variety of options, and two of the most popular choices are mutual funds and index funds. Both are considered relatively safe investment options that allow individuals to invest in a broad range of assets, but they have some key differences that can affect the way they perform and the type of investor they are suited for. In this article, we will explore what mutual funds and index funds are, how they differ from each other, and how to decide which one might be better for you. First, let's start by understanding what mutual funds are. A mutual fund is a type of investment vehicle where money from many investors is pooled together and managed by a professional portfolio manager. These managers are responsible for making investment decisions on behalf of the investors in the fund. The goal is to achieve the highest possible return by investing in a diverse range of assets, such as stocks, bonds, or other securities. Each investor in a mutual fund owns a share of the fund, which represents a proportion of the assets held by the fund. One of the key features of mutual funds is that they are actively managed. This means that the fund manager makes decisions about which assets to buy and sell based on their research and analysis of the market. The goal is to outperform the market by selecting individual investments that will perform better than the overall market average. This active management comes with a cost, as fund managers charge a fee for their services. These fees are typically known as the expense ratio and can vary depending on the fund. On the other hand, index funds are a type of mutual fund, but they are quite different in terms of how they're managed. While mutual funds are actively managed, index funds are passively managed. This means that instead of relying on a fund manager to make decisions about which stocks or bonds to buy and sell, index funds aim to replicate the performance of a specific market index, such as the S&P 500. The S&P 500 is a collection of 500 of the largest companies in the United States, and an index fund that tracks the S&P 500 will invest in the same stocks that are included in that index, in the same proportions. Because index funds do not require a portfolio manager to make active decisions, they tend to have lower fees compared to actively managed mutual funds. The lower fees can make a significant difference over time, as they allow you to keep more of the returns from your investment. Additionally, because index funds are designed to track the performance of an index rather than try to outperform it, they tend to have more predictable returns. However, this also means that they will never outperform the market. If the market as a whole is performing poorly, so will the index fund.
The key difference between mutual funds and index funds lies in how they are managed. Mutual funds are actively managed, with fund managers making decisions based on their analysis and research. This gives them the potential to outperform the market, but it also comes with higher fees and the risk of underperforming. Index funds, on the other hand, are passively managed and aim to replicate the performance of a market index. This makes them a more cost-effective and predictable option, but they lack the potential for higher returns that an actively managed mutual fund might offer. Another important factor to consider when choosing between mutual funds and index funds is the level of risk you are willing to take on. Because mutual funds are actively managed, they have the potential to take on more risk in pursuit of higher returns. A fund manager may decide to invest in riskier assets, such as small-cap stocks or international securities, in an attempt to outperform the market. This can lead to higher returns, but it also means that the value of the fund can fluctuate more significantly, which can be unsettling for some investors. Index funds, in contrast, tend to have a more stable performance since they track a broad market index. This means that they are generally less risky than actively managed mutual funds. However, they are still subject to the overall market conditions, so if the market as a whole is performing poorly, index funds will likely see a decline in value as well. When it comes to choosing between mutual funds and index funds, it ultimately depends on your investment goals, risk tolerance, and investment strategy. If you are looking for the potential for higher returns and are willing to accept the risk that comes with active management, a mutual fund may be a good choice for you. However, if you prefer a more cost-effective and predictable investment option that tracks the market, an index fund may be a better fit. One of the key benefits of investing in mutual funds is the ability to have a professional portfolio manager making decisions on your behalf. If you do not have the time or expertise to manage your investments yourself, a mutual fund can provide you with the expertise of a seasoned professional who is dedicated to making decisions that will maximize your returns. However, it is important to remember that there are no guarantees in investing, and even the best fund managers can make mistakes. Index funds, on the other hand, are often seen as a more hands-off investment option. Because they track a market index, there is less need for active decision-making, and the investor does not need to worry about whether or not a fund manager is making the right decisions. Index funds are also easier to manage for beginners, as they require less active involvement and can be a good option for those who want to invest for the long term without worrying too much about short-term market fluctuations.
The decision between mutual funds and index funds also depends on your time horizon. If you are investing for the long term and are willing to take a more passive approach, index funds may be a better fit. Over time, the low fees and steady performance of index funds can provide strong returns. On the other hand, if you are looking for more short-term gains and are willing to actively monitor your investments, mutual funds may be a better option. It is also worth noting that some investors choose to diversify their portfolios by investing in both mutual funds and index funds. This allows them to take advantage of the potential for higher returns offered by actively managed mutual funds, while also benefiting from the stability and lower fees of index funds. By combining these two types of investments, you can create a portfolio that is well-rounded and tailored to your individual goals and risk tolerance. In conclusion, mutual funds and index funds are both popular investment options that offer distinct advantages and drawbacks. Mutual funds provide the potential for higher returns through active management, but come with higher fees and a greater level of risk. Index funds, on the other hand, offer a more cost-effective and stable investment option, but they are unlikely to outperform the market. The best choice depends on your individual goals, risk tolerance, and investment strategy. Regardless of which option you choose, it is important to do your research, understand the costs involved, and make decisions based on your long-term financial goals.
In summary, while both mutual funds and index funds have their own distinct characteristics, choosing the right one ultimately comes down to your financial goals and preferences. Mutual funds offer the advantage of active management, potentially leading to higher returns, but they come with higher fees and more risk. On the other hand, index funds provide a more straightforward and cost-effective option that tracks the market, offering stable and predictable returns over the long term. If you're someone who is comfortable with a more hands-off approach and prioritizes lower fees and long-term growth, index funds may be the right choice. They offer simplicity, lower costs, and broad market exposure without the need for constant monitoring or decision-making. If you're an investor who is looking for the possibility of outperforming the market and is willing to take on higher risk, actively managed mutual funds might be more suitable for you.